China has to trade, and nobody would say, no, Yanis would not argue, I will not argue, that international trade is not a good thing and helps increase their GDP. That is not the point. The point is, do unfettered capital, cross-border capital flows ensure, A, economic stability, financial stability, and secondly, do they actually exaggerate the rise of nationalism, authoritarianism, protectionism, and fascism even? And they do, because we know that from the experience of Europe in the 1920s and 30s. It's precisely because of the gold standard. And let's face it, today, Europe is living under a new gold standard, and the world is living under a new gold standard, which is the monetary system is in the hands of the private sector, in the hands of Wall Street, the City of London, and Frankfurt. Now, here in Britain, we've put up our nationalist barriers, we've put up our protectionist barriers, we've taken back control, apparently, but not from the international capital markets. They still determine the value of our currency, the rate of interest, whether or not finance is raised, whether or not finance comes in or leaves. So, it's the power of mobile capital, private mobile capital. And I say this again, right now, the low-income countries have been sacrificed on the crucifix of the dollar because private investors, creditors, and speculators stampeded out of low-income countries and straight towards the dollar, which strengthened the dollar, crashed their currencies, increased their borrowing costs, and at a time when they were dealing with the plague, right? And we sit back here and we say, well, that's been good for them. It has.
Okay, so we're looking here at the present and at the future, Anne Pettifor.
Yeah.
There is the cost of borrowing that you mentioned. Who controls financial flows? Yes. The other question is, and we're seeing it right now, the French government, for instance, is propping up those who are temporarily laid off. It can't last forever without the economy restarting. At the end of the day, the question is, who pays for the recovery?
It's a very straightforward answer. There is only one, well, there's four ways to pay for the recovery. We can default on the debt, we can refuse to pay it, we can write it off. But the best way is to create jobs, generate income, and repay those debts. The best way to balance the budget, as Keynes very carefully argued, you don't balance the nation's budget or the European Union's budget by cutting the Europeans' income. You raise their income. You ensure that you employ people and you employ them at decent wages. You make sure that they're skilled. You upgrade those jobs, but above all, you upgrade income. You make sure that people earn more. What this crisis has taught us is that actually we can manage very well without highly paid footballers, but we cannot manage without delivery drivers or cleaners or nurses, and they are all low paid. Their incomes have very deliberately been repressed over austerity. And as a result, the European budgets have never been fixed since the crisis, and they won't be fixed. The way to fix the post-crisis budget is to increase employment in Europe, across the whole of Europe, including Italy, Spain, and Greece. And to ensure that those people who are fundamental to the functioning of the economy are paid decent wages. That way, the budget will get balanced. People will have higher incomes. They'll pay more tax revenues, and pretty quickly we'll solve the budget, just as we did here in Britain post-war.